back to the markets in a little bit. But first of all, I want to talk bonds. Of course, when we're speaking to some of the companies with the largest bond exposures on their balance sheets. Today we have on the show the CEO of Nigeria's Asset Management Corporation, Mustapha Chike Obi, and we also have the country group treasurer, rather, of First Bank of Nigeria to give us some perspective on the Nigerian bond market. Gentlemen, it's great to have both of you on our show. And I want to first of all start with you and your thoughts about the development we've seen and the appetite for Nigerian bonds. Over the last 2 years in particular, we've seen huge interest in our bonds. We've seen the yield curve really widen, at least in terms of the number of the products available for issuers. And of course, we've seen yields come down as a result of the demand. Your thoughts on how the bond market is shaping up in Nigeria these days? Well, let me say that it's developing nicely. And traditionally, in most countries, the bond market is usually far larger than the equity market. And I think that now Nigeria's bond market is getting to be larger in size than the equity market, and that will continue. It's developing. I think a number of things have to be done to increase liquidity and transparency and price discovery. But I think those things are happening well. I think there's been a lot of effort from the DMO to develop the FGN market. But we need some more work to do on the corporate side and on the sub-national side. But all in all, I think that things are developing nicely. As for the yield curve, I think that what you will find is that the yield curve has normalized. The yield curve generally tells you what you expect from inflation and interest rates down the road. And I think what the yield curve is telling you today is that rates will keep coming down, but you can have an upward sloping yield curve, which means longer rates will be higher than shorter rates. But I think things are developing quite well. We'll come to what AMCON is issuing in a little bit, and maybe I should get perspective from you, Ini, on how the market is shaping up. Foreign investor interest is huge these days. Your thoughts on where it's going from here?
Well, I think the dominant theme for most of last year and the build-up was largely the inclusion of Nigerian bonds in the JP Morgan and now the Barclays Global Bond Indexes. So I think, you know, clearly foreign appetite has been driving liquidity, and that's a good thing, a positive thing. We need to remember that our bond market is still relatively young, 8 to 10 years old, so it's still evolving. The important thing is the yield curve has been pushed out all the way out to 20 years, and the developments are continuing to happen. What we now need to see are more products, more liquidity. To that extent, I think the foreign investors or their interest has helped that tremendously. And then more diversification in terms of issuers. The federal government is still the dominant entity. We need to spread down to see more corporates, the larger corporates, begin to enter as well. And that will be the natural next phase of development. I think the argument that many people make is where yields are. And they've come down significantly over the last 6 months. Do you expect to see more corporate issuance at the current levels? Now we're seeing some bonds closer to 10%. In fact, it actually dipped below 10% recently. Well, the real challenge with the corporate issuers is size. You've got to look at some of the corporates and their willingness to subject themselves to the discipline required with respect to financial disclosure and the right kind of structuring to issue. There have been a couple of corporate issues. A variety of firms have done so in the past, but usually what we tend to see, they're typically small, and that perhaps limits appetite. I think as some of the larger corporates will take advantage of the current yields, and as we look towards where government is going with respect to unbundling and selling off its power assets, some of those entities will have to raise capital, probably through the bond market, so we should see it evolve. Mustapha, I want to come back to the bonds that you have in the market. Up to recently, they haven't been actively traded. Some people say because they are zero-coupon bonds. We know that we have that big maturity at the end of this year. Can you just give us an update on how you're preparing for that and how you think things are likely to change, especially from the perspective of foreign investors and their interest in your bonds? Well, we had a non-deal roadshow in the U.S. 2 weeks ago, and there was a lot of interest in AMCON's next issuance of bonds, the refinancing of the existing bonds. The zero-coupon may have been an issue, but the AMCON bonds were issued directly to the banks in exchange for the non-performing loans and to recapitalize some banks. And so they were issued directly to them. And we always knew that the banks would not be very willing sellers of those bonds because what are they going to do with the liquidity that they get? So there are a number of reasons why AMCON bonds haven't traded as well as we would like. But like we're about to announce 3 institutional market makers for AMCON bonds specifically.
They will have to maintain markets of a certain size, and they will reward them, will pay them a fee every quarter based on the amount of bonds they've traded. I think that will enhance liquidity.
So you're looking at the zero-coupon bonds as they are issued right now. They will start making markets on those
They'll start making markets on those bonds, and they have to maintain markets. But for that responsibility, we'll reward them with a fee at the end of the period, based on how many bonds they've traded.
Do you anticipate that there will be appetite for the bonds with this market makers structure coming into play?
Well, in many markets in the world, I mean, the critical thing is when you appoint primary dealers and market makers, there needs to be some benefit that accrues to them. Once that is defined, once the number is limited, then naturally you would expect that they play that role. So I think it's a positive development. I think there is appetite for AMCON bonds out there. They recently have started trading. We are seeing the secondary market trades going on. And I think as we approach the December maturities and the refinancing, clearly there will be a lot of appetite, and we should see a lot more activity, especially where the bonds, if the bonds are issued or refinanced at market levels.
Right. Of course, at some point, speaking to a lot of analysts, investors, there were some concerns about the capacity of AMCON to refinance, if you like, this zero-coupon bonds. I want to get your thoughts on where we are and how confident you are that that would not be an issue. Some people say that there are some mitigants. If, for instance, AMCON is unable to provide the cash to refinance, they would, the CBN could step in as a willing buyer as well. So can you just talk us through the process towards December 2030?
I think Ini made the crucial point. If we refinance with a coupon-paying bond at market, I don't think there'll be a problem. So there'll be a market clearing price, and we intend to issue at market. From all we're hearing, we think there'll be enough appetite. But we're not going to stand on our laurels. We're going to work very hard in the next 3 to 6 months to, again, establish market makers, set up a process where there's price discovery and there's liquidity. And I think that if people know they can get in and get out of AMCON bonds without too much of a fee in terms of bid-ask spread, I think you will find that there'll be no problem. But we intend to issue at market, and we think that we will do everything that we can to make sure that it goes smoothly.
All right.
We're quite confident.
We'll continue the conversation after the break. I'm speaking to Mustapha Chike, the CEO of AMCON, and the Group Treasurer of First Bank in Yebong. After the break, we'll take this discussion further, and of course, we'll give you an update on West African markets. We're back in 2 minutes.
It's a new dawn in Africa, and our enormous potential and opportunities are being harnessed by One Bank. One Bank stands strong as the bank of choice for Africans and Africa-related businesses. UBA, with a fast-growing presence across Africa and in key global financial centers, UBA has a wide range of innovative products and services in retail, wholesale, and commercial banking tailored to the needs of individuals and businesses in Africa, delivering convenience to customers and facilitating payments, remittances, trade, and economic development. United Bank for Africa. UBA is the one bank uniting African people and businesses with the world. So, make the wise choice today. Bank with UBA, Africa's global bank.
Power Lunch brings you exclusive interviews from market movers and shakers, only on CNBC Africa, first in business worldwide.
Power Lunch, brought to you by Altec. Leading technologies, touching lives.
With a GDP of 2.5 trillion rand, 3 times that of its southern African neighbors, and 20% of the entire GDP of Africa, South Africa is regarded as the powerhouse of Africa's economy. From tourism to telecommunications, infrastructure expansion to transport, Business Spotlight brings you an in-depth look at what drives the country's growth and development today and into the future. That's Business Spotlight, only on CNBC Africa, first in business worldwide.
Welcome back to Open Exchange. It's a pretty mixed picture in West African markets. Yesterday, let's start our update from the BRVM. The BRVM 10 index yesterday closing at 220 points, up 1.7%, and the BRVM composite up 1.65%. Total value traded in that market was 549 million CFA francs, and the currency holding at 505 CFA francs to the US dollar, putting the year-to-date change for that currency at negative 1.25%. And moving on to the Ghana market, also a positive day. In fact, that market has been streaking over the last few sessions. It was up 1.5% to 1,555 points for the GSE Composite, and the GSE Financial Stock Index that closed at 1,365 points, up 2.2%. The year-to-date change for that is 31.3%. The CD slightly weaker at 1.92 CDs to the US dollar. Moving on to Nigeria, of course, that market has seen some pressure from profit taking recently. We've seen the NSE index closing at 32,784 points, down 0.5% yesterday on the back of the profit taking that we have seen over the last few sessions. Indeed, the market has come down over the last 3 trading sessions. So we'll come back to our conversation with the CEO of AMCON, Mustafa Chikeobi, and the Group Treasurer of First Bank. We're talking bonds, and Mustafa, I know you used to trade bonds before you arrived at AMCON, so I want to get your thoughts on the issues you see with the way our market is presently constructed for bond trading. We've seen a lot of progress over the last 6 years. Liquidity has improved. We've seen a yield curve extend to 20 years. But what do you think is missing in the way we trade bonds in this market now?
Well, there are a number of, these are natural development things, so it's not a criticism of what has happened to date, but things develop naturally. I think that there's more of an investment mentality versus a trading mentality, and those are two different things. I think that people have to develop a trading mentality, and most of the places I see, the investment and the traders are the same. And I think that we need to start trading. We need to have, but trading requires a lot of risk management, a lot of analytics, a lot of support, and I think that we'll get there naturally, where people are just buying to make markets and to get at the end of the day. So
what are you saying? Are you saying that we're buying to hold a little too much?
There's a mixture of trading and investing. And trading is a distinct activity from investing. And I think that when the market gets more developed, you see that separate. You have distinct traders from people who are investing. So I think that that's something that has to happen. We have to have traders. That's one of the reasons why we want to have market makers who will be purely traders. The other thing that is that banks are giving people the option, the corporation the option of borrowing beyond 3 to 5 years. Those are capital market activities. So I think that the corporations, if they realize that the banks will not lend them money beyond 3 years, and the banks insist that if you have a project after longer than 3 to 5 years, you should go to the capital market, you start seeing corporations come to the market more often.
Do you think regulators or authorities need to change the dynamics in any way to support that?
I think it's getting there. I think that banks are now less willing to lend long. And I think that banks are, and people have to borrow. For example, mortgage financing in the U.S. Even though banks may facilitate it, it ends up in the capital markets. They're bundled together and sold to long-term investors. Banks have no business providing long-term funds for projects. So anybody who wants to borrow mortgage financing or want to borrow beyond 5 years, infrastructure, should be something that happens in the capital markets. And as the banks start separating themselves from those things, you see more corporations, like you said, the power industries will have to go to the capital market. They have to go to the bond market. And I think that when that happens, you will see many more corporations coming to the bond market and a further development of products in the bond market.
Do you want to share a few thoughts on that point?
Well, I think I agree with what he said to a large extent, but I think we need to put everything in perspective. As of 2003-2005, our yield curve was only 6 months, right? So we've extended it over time. Now, yes, we've seen on the asset side that growth has been faster. The liability side is only beginning to kick in with arguably the pension reform that's kicked in, which is only a 5-year-old industry. So that begins to provide the natural appetite, investor appetite to take up these issues. We are seeing natural evolution in terms of where the bond market is. And corporate issuance is only just a matter of time because, yes, he's right. We do have, as banks, significant asset liability mismatches in terms of funding term.
Right.
And that will only grow as the infrastructural development needs need to be financed in the economy. So really where we're at is at the cusp of the true development of our capital markets in terms of raising longer term financing either from the bond or equity market.
Analysts I've spoken to earlier said that there are capacity issues, and that's perhaps something that the DMO needs to address. Some of the primary dealers and market makers are not making markets, and it's simply because they don't have the capacity to do so. They don't have the knowledge, the skills. Do you agree on that point?
Well, I agree. Clearly, in my opinion, I think the DMO needs to take another hard look at its whole primary dealer market making mechanism. Arguably, there are probably too many market makers, primary dealers. Perhaps if we limit the number and focus, and then the DMO can insist that those appointed primary dealer market makers actually play the role they were set up for, or they did take the licenses for, and make markets in the way that is anticipated.
Right. Mustafa, like I mentioned earlier, we've seen huge foreign interest in our bonds. You mentioned that you're also seeing some interest in your bonds. What else do you think we need to do differently, more so that we're engaging an international capital market these days?
Well, I think, again, there are a number of structural things. We, for example, at AMCON, we're buyers of AMCON bonds because we made some recoveries and we have some cash, and that's one of the best things for us to do is to buy back our bonds. And we're finding it difficult to buy enough bonds fast enough. So I think...
So you want to invest in your bonds because you have excess cash?
As we recover, we want to buy back some of our bonds.
Right.
But we're finding it difficult to buy them at a fast enough rate.
Right.
And so I think that there are a lot of structural issues in the market that were necessary. You know, when you're growing, you put a lot of shackles and restrictions.
Yeah.
But when the market matures, I think there are a number of things that are structurally make it difficult for people to trade bonds as easily as they can. I don't think that, for example, it's quite so easy for a retail investor to buy bonds as it could be. Right. But those are natural things. You want to make sure that you restrict it to people who know what they're doing, and as people get more and more knowledgeable, you expand the universe. Right. So I think there are things that can be done, that can be looked at again by the regulators and the primary market makers to make things a lot easier.
All right. Thank you so much, gentlemen, for joining us. It's been a useful conversation. Mustafa Chike, the CEO of AMCON, and Ini Ebong, the Group Treasurer of First Bank. Now, moving on to Ghana. Ghana has unveiled plans to trim its fiscal deficit to 9% from 12% by raising tax revenues from key industries and avoiding tough spending cuts. Today, the West African country commemorates the day it gained independence from British rule 56 years ago. Tumisho Maganyele reports.
With a total surface area of approximately 238,000 square kilometers, Ghana is home to some 24 million people. The country is the world's second largest producer of cocoa, with agriculture accounting for a quarter of GDP, employing more than half of the country's workforce. Ghana is also well endowed with natural resources and exports gold, cocoa and timber to France, the Netherlands and USA. Imports like capital equipment, petroleum and food products are sourced mainly from China, Nigeria and the US. After pumping oil for the first time at its Jubilee field in 2010, Ghana's GDP soared nearly 14% in 2011. The country was also one of the world's fastest growing economies last year, with GDP growth of 8.3%. Ghana's fiscal deficit, however, reached 12% when spending overran during the election, and revenues were hit by lower than expected oil production. The West African country has remained stable in a region that is currently plagued by coups and civil unrest. Ghana solidified its political maturity last year after Vice President John Mahama peacefully assumed the presidency following the death of President John Atta Mills. President Mahama has a tough task of balancing the socio-economic promises he made to the citizens of his country, while reassuring international investors that he can keep the country's debt in check. Tumisho Maganyele, Johannesburg.
That's all we have for you on Open Exchange West Africa from the team today. After the break, we cross to international programming. CNBC Africa is back at 12 p.m. Central African time with Power Lunch. So keep watching CNBC Africa. We're first in business worldwide.